Well, Chris, welcome to Equity Mates.
Thanks very much for having me back on. I think maybe about 4 years ago.
It was
I
a
made my
while,
Equity
yeah.
Mates debut, so it's great to be back.
Clearly remember it. Pre-COVID, I think,
Must have just been pre-COVID, I reckon. Yeah.
If not, we were right in the thick of it.
A lot has happened since then.
Yes, yeah. Well, that's probably a good place to start. Before we kick into the fund and your approach to investing and investing philosophy, perhaps can you just talk us through the journey that you've been on from leaving footy to now essentially setting up your own shop?
Yeah, so I guess my last game of competitive footy was almost 10 years ago. I left that and was lucky enough to get a gig as an analyst at a venture capital fund, which I did for about 12 to 18 months. And I guess I've been investing in listed equities since the age of 18. So whilst I was working at the venture capital fund on the side, I was investing a lot in listed equities. Might have seen 200 odd deals with that VC fund, had the ability to co-invest in any of them and didn't want to. But at the same time, I was finding lots of listed stuff that I was buying and investing in and doing well with. And then after a while, it just made sense to spend my time looking at deals that I really wanted to invest in, as opposed to other deals which suited different investors, but just weren't stuff that appealed to me. So at that point, became a full-time private investor, did some AFL media on the side to help with cash flow, and had been doing that up until 13 months ago when decided to launch the Cerutty macro fund.
Nice. Investing since 18, so would have been all through football. Was that something your parents instilled in you, or what was the motivation there?
Yeah, so my parents are sort of financially illiterate. They're smart people but have zero interest in money or investing. My grandpa liked investing. And so I think it was 16 when I bought my first shares, and that consisted of I got some money from the AIS for winning a football scholarship. And me and the old man walked down to the news agency. We bought a shares magazine.
Nice.
Flicked through the different ideas. And then we were tossing up between Woolworths and AWA Group, which was a small sort of electrical OEM. And we bought AWA Group, and that doubled fortuitously. I think it's gone now. Well, I don't think it is no longer a listed equity. So we got lucky, and the rest is history.
Wow.
Yeah, I think Woolworths was $5 at the time, so we would have done a lot.
You would have done well, yeah.
Better with Woolies and the divvies over that time frame. So lesson learned. But that was the first experience as a 16-year-old, and I think I just loved the competitiveness of it. You know, there's a scoreboard with listed equities, and you're either right or you're wrong, and it doesn't matter if you've tried hard or if you're this. And I'm never one of those people that scream saying, "Oh, the market's wrong." The market's always right, and it's a game that you're able to play till you're very old, which appeals when you compare it to professional sport.
I still remember when we first spoke, one of the things that I walked away with was your story that you loved investing so much, even when you were playing footy, that on the day of a game, you couldn't read the business section because you'd be thinking about
couldn't read
investing.
The fin review, that's right. Yeah.
So this has been a long journey for you to get where you are today, running your own fund. So how has your investment philosophy changed from, first buying AWA all through your footy career to now where you are today?
It's evolved. So as a private investor, I loved, really micro cap opportunities where there's huge asymmetry. And what asymmetry means is the value of that stock can go to zero, but it can 10, 20, 30x potentially. And you can wear some big losers in that world if you do get things that 10, 20, 30x. And so that was how I was investing in a private capacity. And then that really changed a few years ago when I sort of got sick of dealing with the quality of management at that level and dealing with, promises about what's going to come as opposed to what actually does. And started putting a lot more value on broad market liquidity around that time too. So probably 3 years ago, started investing in both local stocks, but investing overseas as well. There's some real anomalies about our market because there is such a huge amount of money chasing not that many different companies. So we don't want to buy supermarkets, but if we did, Australian supermarkets are just so expensive on a relative basis compared to all other supermarkets because they're a defensive position. And when super funds want to hide somewhere, that's where they go. So 3 years ago, started investing a bit more in large cap opportunities and overseas, And essentially the fund is an extension of that. So the strategy hasn't changed. I guess as a private investor, when things had worked really well in a period of time, I would take that money out and put it in property. And that felt like that money was sort of out of the game and safe. And I guess as a listed investor now, when we think liquidity, broad market liquidity is tight, we want to go to larger cap opportunities that are producing a high amount of cash flow, so low PE type stocks. And then when liquidity is loose, we're happy to be in some smaller cap type positions or things perhaps which aren't producing as much cash flow. So rather than that idea of taking money out of the game and putting it in residential property, there's still that appreciation of what liquidity is doing, but it just changes the type of companies that we're investing in.
Now, the last few years since we last spoke, I think we've lived through both extremes there. We've lived through very loose liquidity in 2020, 2021. God, that was a good time.
Yeah.
And then quite a tightening of liquidity 2022, 2023.
Yeah.
So I guess you would have learned a lot about that strategy and stress tested that philosophy over those years. What did you learn, and why is liquidity so important?
We think liquidity is underrated by the average investor, and we think liquidity is what moves asset prices. And we think investors, not all investors, a lot of investors constantly just talk about the economy and what the economy is doing. But if you think back to that time you mentioned in COVID, and you think back to what happened in residential property, we had no migration. We had the biggest economic crisis since World War II. And property prices were ripping because interest rates were zero and liquidity was being stuffed down everyone's throats. And we think that's important for investors to come back and remind themselves when they're reading stories about the economy being soft, because a soft economy opens up chances for increased liquidity because inflation is often less of a concern when the economy is softening. So if we look at the US at the minute, we think the liquidity environment is quite conducive to asset prices, but we think the economy looks like it's softening, and we're clear to delineate between the two.
So liquidity is one of the, I guess, pillars that make up your investment philosophy or approach at Cerutty Macro, but obviously macro thematics more broadly and the business cycle are the other sort of two pillars. So can you talk us through those?
Yeah, and it might just be worth elaborating on liquidity for a second, because to a lot of people that might mean to them how many shares are being traded in the screen. But for us, it's that central bank liquidity that's really important. So the most basic measure that a lot of people use is the central bank balance sheet minus the RRP and the TGA, which is the US's checking account. So people can go and Google what that stuff is, but it's that sort of liquidity that we take most notice of, not so much how many shares are being traded on the screen. In terms of a macro level, I mean, whilst we're a macro fund, we only invest in listed equities. Generally, a macro fund invests in foreign exchange or direct commodities, or with leverage bets, we don't use any leverage and we're long only in equity. So the name can be a bit misleading, but essentially what it means is our ideas come from top down as opposed to bottom up. We like that for a couple of reasons, because it's easier for companies to do well when they've got a tailwind. And it's also not how most funds and people invest in Australia. And we like to be doing things differently because we hope that our returns are going to be different. If you look at how funds get remunerated, they get paid when they outperform an index. So that's conducive to funds that are really good at bottom-up analysis, and they relative trade stocks in that index to try and get that outperformance. Whereas whilst we've got an index, a benchmark that we're trying to beat to earn performance fees, we don't even look at it in terms of how we invest. So it's a different model to how most funds invest. And the reality is that a fund, you can get a big performance fee if you're down 20%.
Yeah.
If your index is down 40%, that's a chunky performance fee, which people don't sort of think about that.
Making money.
That's right. And we just come at it by how can we make money, not how can we perform the index. My liquid capital is in the fund, so it's just highly unlikely any performance fee is going to outweigh the damage to my personal P&L as an investor in the fund. If we're not trying to make money. So that's how we view it. And then we certainly don't ignore the bottom-up analysis and the importance of management and economic moats and unit economics of the product or service that company's trying to sell. But we very much start with a top-down framework.
I really appreciate this because we speak to a lot of investors here, and we certainly sense trends over time. And I think right now a lot of investors are bottom-up stock pickers, their growth at reasonable prices. You sort of hear those
quality.
Yeah, quality. Yeah. And there's nothing wrong with that, but it's just a crowded place to be an investor now. And so I like that you are coming in here with a differentiated view of the world and a differentiated way to make money compared to a lot of investors we're speaking to. I think a lot of people listening will want your take on where we are now in the business cycle and where liquidity is and where it's going. But before we get into the specifics of today, I still want to, I guess, keep it general. Macro trends, the business cycle, and liquidity. Why just those three sort of pillars? Was there anything else that you've looked at, you've incorporated, you found it didn't really move the needle as much? And I guess, like, how do those three things sit together as well?
I don't think there's one way to... I don't think the way we invest is the best way. I just think it's the best way for us and for me personally. There'll be some guys that are great at maths that are suited to algo trading. There'll be some guys that are, actuaries or accountants, and they're much better suited to bottom-up analysis. I guess I just noted when... I became a full-time investor and I had a full day with no meetings and I could read macroeconomic research. I could do that for 6 or 7 hours at a time and feel energised going home. And that was just a really good clue. This was a good place for me to fish because it suited my personality. It didn't feel like work. It gave me a way of explaining what was going on in the world. And I think that was how football felt for a large chunk of my time. It didn't feel like a job. It just felt like an extension of how I wanted to live. And so if you're lucky enough to find that, and that's really hard to find, I just think it makes sense to listen to it. So that's where it came to me. And in terms of why, I guess, macro liquidity and then bottom up, I just guess that's just what's worked for me. It's just sort of that muscle memory. You look back and you make a trade, you execute it, you review, and over time, the things that have worked have been things with a really strong macro tailwind. We've all lived through an environment where liquidity is ripping and when liquidity is tight. We all lived through post-COVID when money supply went negative in the US and what that felt like. And it was hard to make money. We're all smug post-COVID and giving advice and,
Yeah. We all gave a bit of a back.
The market's good when investors are giving advice on stoicism and, philosophy because making money in markets has just become too easy. So the stoicism advice is sort of gone and everyone's back to grinding, trying to make money in markets. But that liquidity is just such an obvious thing. And even if you look at listed equities, generally go up 7 or 8% a year. Money supply generally increases 7 or 8% a year. Our view is that the equities haven't gone up. The thing measuring them has gone down by 7% a year. And we think that is really underappreciated. Even when people talk about the doomsday scenario of the Great Depression in the US and equities dropped 90%, they didn't drop 90% against the US dollar being debased. They dropped 90% against gold, right? And I think that's what gets missed. We're in a very different environment now. We've got huge deflationary forces in tech. We don't always see it flow through to the economy because there's a huge debasement of currency, and you don't generally see that in cross-currency scenarios because everyone's doing it. Yeah. But we're starting to see it in gold. We've obviously seen it in Bitcoin. We've sort of felt that in house prices and how they've moved, compared to people's wages and population growth. So there are clues there if you're looking closely enough, but everyone still just focuses on the price of the asset. Not many investors focus on what's happening with the denominator.
Yeah.
That's a good point. So when you're looking for a macro thematic and you've spent 6-7 hours a day reading about macro themes and how the world is working, what are the characteristics that you're looking for to truly say, this is a meaningful thematic that I can invest in versus this is just a fad that is only going to last 18 to 24 months?
Look, I think the difference between a fad that's a bubble and something that's meaningful is how much value that product or service is creating for the people using it. And in terms of macro trends, they're generally long-term secular trends that are going to last longer than a couple of economic cycles. Not in a straight line, obviously. Things that are going to be around 5, 10, potentially 15 years. And the last thing, and probably the most important thing, is if it's already on page 1 of the newspaper, it's too late. Yeah. We can still be there. We'd like to be early or on time. We don't want to be late. So copper is a bit of an example. We've got a small amount of copper exposure. We quite like copper. I haven't met a fund manager in years that doesn't like copper. So we don't want that to be one of our biggest positions because everyone loves it. Everyone can see not only is it used for EVs, but it's used for renewable energy, it's used for data centers, it's used for the electrification of everything. and supply appears to be constrained. So everyone's there. So we're happy to still play there a bit, but the positions we're most excited about are ones where we think there's a long-term secular trend that I think Kevin Muir puts it is on page 17 today and on its way to page 1 tomorrow.
Yeah, right.
Well, talking about what you're excited about, when we came and sat down this morning to get started, you mentioned that the JD Vance appointment was interesting, and we said, hold that thought, we need to be recording this. So tell us why that's an interesting one for you from an investment point of view.
So this may take a while, but we've got a bit of time. But let's go back to 2022 when you had $300 billion worth of Russian FX reserves sanctioned by the US. This was a huge event, which probably not a heap of people, in the street will be talking about. But keep in mind that the Nazis didn't get their foreign FX reserves or their government bonds sanctioned in World War II. So that's how significant this was. And since that time, we've seen central banks of foreign governments buy more and more gold and use that as a place to store their reserve assets rather than storing their reserve surpluses in US government bonds, which has been how the world's operated since the 70s. A lot of people just view that as that was a real mistake from the US because people would sell off their bonds. It would be harder for the government to fund their deficits. But we found that hard to believe, and we thought at the time maybe the US is now in a space where they think a hot war in China is possible in the next 10 years. And they also realise it's going to be hard to win a hot war if you can't manufacture your own products. So we've seen the capex cycle in the US tick up off a really small base, but that industrial manufacturing capacity isn't going to get anywhere if the US dollar is too high because no one's going to be able to buy those products. There's not going to be an export market for them. And when you listen to JD Vance and some of his questioning of Jerome Powell, he really hits home on this point and seems to be acutely aware. And you go back to the lessons of World War II, it was really the manufacturing capacity is what wins hot wars. And let's hope this never happens, but it's much less likely to happen if the US is prepared. And so I think JD Vance is aware of how vulnerable the US is if they don't have their own manufacturing capacity, which means he's going to work very hard to weaken the US dollar. And we know Trump's spoken about the US dollar being too strong as well. And we think it can be hard for countries to strengthen their currency, but if you're desperate enough to weaken it, we think they're able to do that. So we think that's got a lot of implications. So one being, if we're no longer in a world where countries like China store their surplus and excess reserves in government bonds, but if they choose to store that in gold, that's a different world to the one we've been living in. And it also opens up the ability, which is what we've seen, where countries are starting to buy commodities in their own currency instead of in the US dollar, albeit small but growing. What that also means is you can buy more commodities. Let's say you're India, you can buy more commodities because the reason you have those bonds is so that the currency can't get away from you when you're buying commodities in USD. So we think it's very bullish for commodities, that softening US dollar environment. It's potentially bullish for US manufacturing, but those equities are going to be measured in USD, so that's a tough place to be. But things like the yen US dollar valuation gap, where the yen's at close to 160, is wildly high, and you think there's a potential snapback in those sort of currencies.
Before we start talking about the implications, let's just talk about the how, because the death of the US dollar has been called before.
And we're not calling that at all. Yeah, we just think it's a softening. And also, I don't think it's not what the trade gets done in that's important. It's where the money's stored afterwards.
Okay, yeah.
So if you're using a currency, let's say you're buying $2 million worth of grain and you buy it in US dollar, we don't necessarily think that's going to change, but it's after you've done all your trading and you've got a surplus of X US dollars, it's where that gets stored. What's the reserve asset? We think that's what's really interesting and important. And more that's becoming gold.
Yeah, okay. Interesting.
And so then you've got to look at, well, how are they going to fund these deficits? They've got 7% deficits of debt of GDP. So how are you going to fund a $2 trillion deficit if countries like China and Russia aren't allowed to buy your bonds? What's going to happen there? So there's some really interesting long-term questions.
Yeah, I mean, massive. Like, structurally for the US economy is massive.
Huge.
Yeah.
Huge.
Like,
so we think to ignore that at your own peril. I mean, everyone talks about the different bubbles we've had. You know, when crypto springs to mind, or, you know, tech stocks. No one talks about the bubble in government debt.
Yeah.
We had $18 trillion worth of negative yielding debt only a few years ago. I find it hard to even compute that you can have negative yielding debt.
Yeah.
It's so weird.
Yeah.
You know, imagine putting your money in a bank and paying for the privilege. But there was $18 trillion of this stuff. And that's what led to all the other bubbles.
If they were to debase the currency, one way to do it would be to get the Fed to print a lot. And based on, you know, what you're talking about before about liquidity, that would be good for growth assets for a time being, at least. So if Trump and JD Vance get elected, are we going to go back to 2021? Is that the start of the thesis?
I don't know. I think the other thing you had then was you had zero interest rates, and I don't think we're going back there. I think if you look at tariffs, which are a big part of their policy, are inflationary. Bringing onshoring manufacturing capacity is going to be inflationary. So I think the idea that rates are going back to zero is hard to see, because that was a world where you had really tight fiscal spending and really loose monetary policy. This is pre-COVID years. And then you had loose monetary and loose fiscal post-COVID. So I think that's hard to... And I don't think it'll be the exact same. So I'm not sure if you followed the Fannie Mae and Freddie Mac. They're the two big sort of companies involved in mortgage providing the US. They've just opened up a proposal where US homeowners can get a second mortgage on their home and redraw that. But the thing about US mortgages that are interesting is when you buy a home in the US, your interest rate's fixed for 30 years, which you would have heard about, which is very different here. Yeah. But you can redraw it at that same rate.
At the rate you fixed it.
Yeah.
Oh, wow.
That's not bad.
So all these people on 2%.
That's right. So when
is that a new thing?
Yeah. So
because they realise no one's going to go out and take another mortgage if you're at 2%. They don't not want to go and take.
Or is that what QE looks like next time around? So the idea that it'll just be the same type of program, I think it'll be, you get the same liquidity effects. It'll be done differently.
Yeah. Okay.
Right. So that won't technically be on the central bank's balance sheet. It'll be on Fannie and Freddie Mae's balance sheet. Or will you have, they've changed sort of the SLR rules when commercial banks in the US buy bonds, where that changes their reserve ratios, and essentially they can buy as many government bonds as they want without punishing their reserve ratios. So that's another way of getting liquidity in. So I think the liquidity will come. I just don't think it will be exactly the same as what QE was.
Yeah.
And I think that'll be, that'll assist with a weaker USD policy.
Wow.
God, it's so fascinating, because even then I'm thinking about there'll be like cross-cutting policies, because on one hand, like the administration would want a lower USD, but because they want to put a 10% tariff on everything, a 60% tariff on goods coming from China, and onshore all this manufacturing, inflation will be higher, and so the Fed will be raising rates, and then that will have generally, if you're raising rates, it's good for your currency. But then
unless you get into sort of a yield curve control environment, which is extreme. But I mean, the last time debt to GDP was this big in the US was post World War II, and that's what they did.
Yeah,
they just capped yields, and inflation ripped, and then eventually over what was it, about a 30-year period, the debt to GDP ratio was fine just because it had been inflated away.
Yeah.
There's not many parallels that we have to this level of debt to GDP. No. It's really unique. Another very abstract idea around, who's going to buy the bonds, because I think that's really important, is, an appreciation of stable coins in crypto markets. And I'm not a crypto guy at all, but it is starting to overlap when you look at JD Vance's history with crypto. And generally people just look at sort of Bitcoin or shit coins in crypto, but I think stable coins are a really important thing for people to understand. Do you guys understand? You're familiar with stable coins?
Or it's a little bit, like Tether and stuff like that.
Yeah, so stable coin should mirror US dollar stable coin, should mirror US dollar 1-to-1.
Mm-hmm.
So when you buy, let's say you want to buy some crypto, first step is you invest $1,000 in a stable coin, then you use that to buy your crypto. That stable coin company invests that $1,000 in short-term US government debt. right? And that's how they make their money. If short-term US government debt is yielding 5%, like it currently is, they're making a huge amount of money. But they're now, I think, the 10th biggest buyer of US government debt.
Really?
Wow.
The stable coins?
Yeah. So if that gets big enough, the answer to who's going to buy the debt, right? Who's going to buy it? If China's not buying it, if Russia's not allowed to buy it, Saudis don't want to buy it. They're buying soccer teams because the currency's being debased.
Crypto guys.
If Bitcoin if that market gets big enough, and meaning the stable coin gets big enough to service that, there's your new buyer of US government debt. And when you think back to the parallels of the oil market, there's transcripts of Saudi oil ministers in the 70s when the oil price was starting to rip. And one of the ministers was saying to the other, we can't do this. The Americans will come to war if we, 4x the price of oil. And the other one writes back and says, no, Kissinger's the one that told us to do it. Because what America needed is they needed the profits of the Saudis to be big enough that they could recycle that into US government debt so that the US could continue to run deficits.
Right.
Because that was the arrangement. You make profit off the oil we pay for, you recycle that into our government debt, and that keeps going. So that's the world we've been living in. That world's ending. Right? So what comes next? And this is a bit harebrained and not great to talk about when you're an equities investor, because people go, you guys crypto bros? And I'm no, we're equity guys. But these are the sorts of things that you wonder with a VP like JD Vance, the murmurings Trump's been making about Bitcoin and crypto, if stable coins are going to play that role of, and they don't buy long-term government bonds, they only buy T-bills, short-term government bonds. But if you look at where most of the issuance is going now in the US, it's going to T-bills. It's not going to longer-term debt. So there's some food for thought.
Are you making active investment decisions at the moment on the assumption that Trump gets in?
Yes. Yep.
Nice.
Has that been the thesis for a while, or has recent stuff emboldened that? Well, I guess JD Vance is only recent, so...
Yeah, I think we had we just didn't buy... We had a thesis that the US dollar would be weakened, not dead at all. So we're not those guys. Yeah. But we just thought it would weaken just because it sort of needs to for the world to thrive. Everyone's debt is in USD. The economies all around the world, they struggle to thrive if the US dollar is too strong. So that was part of the thesis, and then it's been strengthened by the fact that it looks like Trump's going to win, and JD Vance has sort of been a part of that too. So it hasn't changed dramatically. We were sort of positioned for that world anyway, but noticing the rotation out of NASDAQ and the Mag 7 into the Russell 2000 and the smaller stocks in the US, we feel that's significant.
Does the thesis long-term change if Trump doesn't win? By some of those overtures, like Biden's been trying to onshore manufacturing, the idea that, they're preparing for a potential conflict with China, those things don't change who's in power. Does the thesis change in a big way?
Not really. I mean, the thing that we're really anchoring on is that 122% debt to GDP in the US. That's the big thing that's got to be solved. And so we're making bets largely based around that and what options you have when you couple that with fiscal deficits of 7% of GDP a year. What world can work in that environment? That's sort of what we're looking at. Yeah. So that's more important to us. If the debt was at 70% of GDP in the US, then that would cause us to rethink what we're doing. More so than Biden or Trump. We don't think there's a lot of options here. And when you've got that much debt, deflation's terrifying. And to have these deficits when the stock market's at all-time highs in the US, property market's at all-time highs, unemployment's, 4%? That's as good as it gets. There's such a huge amount of their tax receipts rely on capital gains to still be pumping out 7% deficits, which is just unprecedented outside of world wars. We think that's significant.
So what's your time horizon when you're looking at investing in equities when some of these trends, macro trends, these aren't going to unfold in the next 6 months? This is big structural macro. What's your time horizon?
Generally thinking 18 months to 3 years.
Okay.
But we hate holding things that we look at that we feel are expensive. So if we were to buy something that we really liked on a long-term macro trend, we might have met management a couple of times, love what the company's doing, and the company were to double in 2 days' time, and we think it's now, 30% overvalued, we'd start trimming.
Yeah.
Even though we still love it.
Yeah.
So we just try and be really disciplined about that, which can be annoying because there's just companies and management teams you just think are stars. But if they get too expensive, we just try and be disciplined to trim and or sell. So we're not collectors of positions.
Makes sense.
But when we go in, it would be an 18-month to 3-year time. But there's times when we're buying stock as we're doing DD, and we might buy a stock because it can be hard to get, and it's often a race. You're racing against other fund managers to get, or other investors, to get that stock. We can be buying and 2 days later discover stuff we don't like and then sell. So, but the mindset when we're entering a position is we should have this for 18 months to 3 years, and if there's still more to follow, hopefully we hold it for 10 years.
Yeah.
And so are you investing across asset classes with some of these theses, or just listed equities?
Just listed equities. We don't short, we're long only listed equities, but we can invest anywhere in the world, but we're essentially an Australian focused fund. It's just if we like a theme and we can't express it here, we'll go overseas. So, big cap copper, we didn't like Sandfire, so we initially expressed that idea in Canada.
Yeah, okay.
But if there's a big cap copper stock here that was sort of comparable to the one we liked, or the three we liked when we first started that position, then we would have expressed that in Australia.
Yeah. I think these examples are great to really bring what you're trying to do to life. The US example we spoke about, the copper example. Is there an example here in Australia that you think sort of brings what you're doing to life?
Some of our positions say, call it CapEx in data centers. So we didn't buy NVIDIA or Microsoft, even though we think AI on a really long time frame, we think will be significant. I think it's probably gotten ahead of itself in the short term, but that the amount of money dedicated to data center CapEx can't be denied. That's just enormous. So we've got a position we like on a service provider for that build out that's done really well, which is sort of a long-term secular macro theme. And that company was just trading a very cheap multiple when we entered because it was largely viewed as a company without an economic moat. But there's not that many companies sophisticated enough to service those big data center providers and the CapEx they need. Underinvestment in oil is another thesis we like. It wasn't long ago the world thought EVs were going to take over all transportation, and there was a general, I won't say misunderstanding, maybe underappreciation of how ubiquitous oil is in all sorts of products, not just transportation. So that was out of favour for a while. We like that. Even things like, super fund flows is a really predictable long-term secular trend in this country. You know where they are today. You're only going to be huge tomorrow, and companies that are able to benefit from that, or even, our immigration numbers are huge and cost of living is high. 2 parents need to work. Some of those childcare providers, their ability to pass on costs to consumers, because essentially the cost increase gets paid by the government, and not funding that increased cost from the government is a vote loser. So there's just sort of some basic businesses that not all the trends are sexy sort of EVs taking over the world. Some of them are just quite simple and obvious, like super fund flows or net migration flows in Australia.
I love that. One thing that we've certainly learnt over our time at Equity Mates is that some of these trends just last a lot longer than we think. And a common question we get is, have I missed this? Have I missed this? But like a lot of the things you're talking about there are, you can realize them in a 3 to 5 year time horizon, but they're multi-decade trends, a lot of them.
I think what's also worth noting is generally have leadership in equities of sort of 10-year blocks around about. And those 10-year blocks, this is Louis Vincent Gave's view, that the themes are either not enough to go round, so eras of scarcity, when there's, I think the 70s where there was strong growth, a lot of money supply, not enough commodities to go around, big commodity bull market. New geography, so I think Japan in the 80s or 90s, it was going to take over the world, or new technology. It's generally one of those three things. It's very rare for that leadership to happen for 20 years. It hasn't really happened before. Maybe it'll happen, but unlikely, at least in our view. So you had new geography, not enough to go around, was China, right? That was sort of a bit of a hybrid. That was BHP was flying in the early 2000s. Chinese banks were flying. These were the 10 biggest companies in the world. Then you had new technology, and that's what we've had, and that's been a really strong long-term trend. Some technologists say, well, that's just going to keep going forever. We take the view there's going to be new leadership, and the new geography for us, if there was going to be one, would probably be India, but we think it's much more likely the new leaders will be in that theme of not enough to go around.
Okay.
Because ESG has been wildly restrictive to producing commodities we need to live. Demographics have been an interesting one where people consume less with when they get older, but there's also fewer people to work at the minute, because you tell people they're a chance to die of a mysterious virus, all of a sudden they decide they want to retire as soon as they can and not wait till they're 65. So a lot of the workforce has been taken out of the system. And we just think a lot of the red tape policies now are restrictive to abundance, and that's I guess where we think the next bubble will be in those stocks that service the not enough to go round theme. And that doesn't just mean commodities. Yeah, that's where we think the most interesting place to fish is at the minute, rather than chasing the leaders of yesterday, which has clearly been technology.
You said that there was a thinker or an author that wrote about that. If people want to...
Yeah, Louis Vincent Gave from GavCal, that's his sort of thesis. And if it's pretty well known, if you just go through the 10 biggest companies, ex-Aramco, the Saudis' nationalised oil company, and ex-Berkshire, who have they been? It just paints a really clear picture each decade. There is leadership change, and it is... It's a pretty compelling thing to look at, so that'd be a good thing for people to check out.
Nice. Yeah, that's good.
Well, Chris, that brings us to the end of today's episode. Thank you so much for coming up to Sydney and speaking with us today. We certainly appreciate it. If our audience would like to find more about the fund, where can they go?
Thanks, guys. Yeah, they can go to ceruttymacrofund.com.au, and there's all the info there, and we've got some monthly reports that people can read and get an insight to how we're seeing markets.
Yeah, the reports are quite interesting. So if you want a bit more of a deep dive on the macro themes that the guys are looking at, then they're all available online. We'll put a link in the show notes. But absolute pleasure to have you back on again. Really appreciate it. Thanks, Chris.
Awesome. It's good fun.
Thanks, Chris.
Equity mind. I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.